This is not good, man. Not good at all for long-term bond holders. What's going on, y'all? Hope all is well. Another episode of Combos with the CFP Mario Payne in beautiful Jacksonville, Florida. Just got done doing my speaking engagement, y'all. So very happy about that, man. So shouts out to Will Singleton and the Dream Big Team in Jacksonville for letting me talk to them about my book. The best-selling book, by the way, Relax Investor, man. Anytime you do a speaking engagement, you're able to help people and get paid for it too. But most of all, give value, which is priceless. How can we beat that? I know one thing, though, my profiteers. I think inflation is going to go down eventually. When inflation is up, that means long-term treasury holders are down. And what happened today makes it even worse. Before we start, though, like always, like, subscribe, share to our channel. Click the notifications, man. Those likes mean a lot as we continue to grow our YouTube page. And also, of course, check us out on Instagram, Painful Profits. Almost to 11,000 followers. Just happy a lot of people supporting us, man. But let's talk about long-term rates and how that might affect us.
Retail sales came in hotter than expected in September, rising 0.7% month over month, showing consumers are still spending despite higher inflation.
So when something's hotter means we're spending more, right? We're doing more. When it's cold, it means it's less. When it's hot, it means it's more. So month over month, last month, not as much spending as this month, right? And for the year, we're spending more this year compared to last year. That means the consumer wants to spend that money, y'all, which means inflation is still high. And it's not going down until we stop spending money.
Excluding auto sales rose 0.6% from a month ago. There you're taking a look at the headline figures, both month over month, year over year was up by about 3.8%. But in that kind of cyclical, or rather...
Man, I mean, it's great because our economy is based on spending. So spending is good. But again, interest rates wise, when we're spending, just doesn't help. Does not help the rates and inflation at all.
Sequential move, I should say, on month over month. A few of the areas that jumped out to me, most notably where you saw declines, were actually in apparel and in electronics, two of the big themes.
I need that background. That's a fly background right there. So yes, apparel, electronics are down. So people aren't spending as much on their consoles, on MacBooks, on Switches from Nintendo and things of that nature. And you can kind of think that, right? So you kind of had had an August back to school. People kind of bought stuff for the children to get ready for school, and then it slowed down in September. I can see that.
That we'll watch to see how that plays out once we get into the holiday season as well.
Yeah, and it's also just what this means here for the broader economy, yes. Right? Because the resilient consumer has really been the focal point as one of the big things that has kept the economy from falling into a recession over the last several quarters.
Well, technically, we are in a recession. I mean, we had 2 negative quarters of GDP. That's a recession. That happened third quarter 2022, fourth quarter 2022. And we have a yield curve that's inverted, which means short term, like something 2 years, has a higher interest rate than long term, which is 20 years. Meaning, I'm a consumer or I'm an investor. I'd rather buy something for 2 years that's paying 5% than buy something for 20 years that's paying 3%, right? So when something at 3% is less than at 5%, it goes down in value. That's what they mean by the inverted yield curves. It should be the longer it is, the more money that you get. Now, the less that you get years-wise, you get more money. That, my friends, is the definition of a recession. We're in it.
Came into the start of the year with many forecasters expecting us to see a recession at this point. So clearly the consumer, one of the more resilient parts of the economy here, and one of the reasons why we have not seen a bigger pullback in terms of growth. But what this means is showing once again that consumers are still out there spending in the face of higher rates, and also in the face of the fact that so many, at least according to many estimates out there, obviously the pandemic era savings.
Now, very true. We're spending money. Another thing that we're doing is not good, though. We're spending it, but we'll put it on credit cards. Credit card debt is at an all-time high. Now, yes, it's more money being spent than 10, 20, 30 years ago. but percentage-wise at an all-time high. So we're spending on credit cards. Now, I know Mr. Painful Profits, Mr. CFP, Convos with CFP, I know. Don't you talk about credit cards? Yes. I put everything on credit cards, and I have everything every single week being paid off, right? So reoccurring, because I want the points, I want the points, I want the points. Flying first class is cool when you don't have to pay for it. So I'm not obliged to you guys using the credit card. But we're using the credit card and not paying it down and off at the end of the month. We're being charged with 15, 20, 25, 30% interest. That ain't cool, my friends. Not cool at all.
Things that dwindling, whether or not that's zero, that's up for debate right now. But again, just consumers under more and more pressure. But 9 of 13 categories saw a rise in sales in this report. There's sales at miscellaneous store retailers leading all categories. That was up 3% from a month ago. And then August's number was also revised higher. So we talk about.
Yeah, so we're spending money, y'all. We're spending money, which stimulates the economy, but it keeps inflation high. So anybody who wants inflation to go down, as sad as it is, we need to have economic struggle. We need to have people not spending as much and saving more. That's going to drive down inflation.
About the fact that consumers are still out there spending in the wake, despite the pressure that they're seeing from higher rates, despite the pressure that they're seeing from persistent inflation. So, of course, this begs the question, how long and if it is going to last?
Well, we don't know that. Mr. CFP does. No, he does not. Y'all spending all that money on Beyonce and Taylor Swift concert tickets, and y'all making inflation go higher.
You know, I kind of think about how the consumer, where they're spending, of course, and that gets revealed through this report, but additionally, how they're spending and whether they're tapping more of the credit right now, tapping, swiping, whatever we're doing.
Swiping, no swiping. Didn't I just say that? Oh, I'm on the wrong side. I have it on TV before, y'all. Y'all see your boy on TV. Am I in the wrong studio? The Relax Investor home studio? Should I be on Wall Street somewhere?
Credit card balances, according to the Federal Reserve of New York, New York Fed continues to publish on a quarterly basis where consumers are leaning on credit more. Credit card balances in the most recent report saw brisk growth, they said, rising by $45 billion, series high of $1.03 trillion. So
over $1 trillion in credit card debt, y'all. That is what we're doing, but we're paying 15, 20, 25, 35% interest. 30, that's high 35. You only do no more than 30. Law got passed about 11 years ago. You cannot charge more than 30%, but that's still very, very high. Predatory lending.
How the consumer is spending and certainly kind of drawing upon some of those cash excesses that they did have, that's showing up now in the data based on how they are spending when they go out to either, for those that are still purchasing furniture out there, furniture was one of the areas that still was one of the kind of interesting year-over-year declines. But then again, you think of...
Okay, we get it. We spend money, it keeps inflation up. If it's pain and we stop paying for profits and we stop spending money, inflation is going to go down. So my friends, we're going to talk about how we can profit from inflation going up in the long run, because it is eventually going to go down. When it goes down, we're able to buy something today at a very, very low price. And when inflation does go down, we're going to make us some profits. It's painful right now, but those profits are going to come home to roost. Let's look at the charts and my profiteers. We want to look at TLT. It's an ETF on the stock market. Of course, I'm a certified financial planner for my 900 clients across the world. On these YouTube streets, I'm just giving information. You guys decide what to do. I'm just giving information. But TLT is through iShares. iShares is one of the largest ETF providers in the world, and it's tied to 20-year treasury bonds. So again, inverted yield curve we talked about, right? 5-year, 2-year treasury bonds are going up in value. Long-term treasury bonds are going down because from an interest rate standpoint, I get more interest paid to me getting something short-term than long-term. So as that's happening and long-terms go down and 20 plus years is considered long-term, then this goes down as well. And profiteers, since March of 2020, it is down by basically 50%. Now, you typically do not see a 50% pull down when it comes to bonds. Bonds, like a 5, 6, 7% downturn is like, wow, that's a lot. But 50%, that is a very, very, very high drawdown. So it has basically took 3.5 years for it to go down by 50%. So from a stock standpoint, I usually tell clients the time it takes to go down, you double that for it to go back up. So let's just say, for illustration purposes, it takes 6 years for inflation to go down and get back to where it was. Now, I don't think we're going to be at 0% interest rates again in 6 years, but let's just say it gets back to where it was. Well, my profiteers, if we get out of this, man, what's going to happen? That is a gain of almost 100%. Break up that financial calculator, $10,000, 100% in 6 years, what? 50, what, 16% a year? Man, I'm a calculator, ain't I? Right, 10,000, 21,000. That ain't that much, man. It's not. But we can be conservative and we can be aggressive. And my profiteers, how can we get aggressive with long term? Well, we can do something that's even better. Look, it's already on the screen. I talked about it so much. Well, if y'all look here and see, right, over the same time period since March 2020, this ETF, TMF, 3 times what long-term treasury bonds are. So long-term treasury bonds go down by 50%. This goes down by way more than 50. It goes up by 50. It makes 150. And as you can see, regular treasury bonds down by 50%. This is down by 92% over the same time period. 92%, my profiteers. That means if I had $100 in this 3 years ago, I now have $8. I'm upset. In the words of Drake, I need to do something about it. You know what? I'm going to do every song that Drake made for this album, for all the dogs. A lot of dogs ain't feeling it. Me, it's mid. I'm going to talk about a stock he talked about on every single stock. The Book of Drake coming soon. Anyways, though, you're upset because you went from $100 to $92. But on the flip side, my profiteers, we bought it today. Now, inflation is probably going to go up a little bit. So I don't think inflation is going to start going down for another 3 to 6 months. However, when that does happen, today, $4.20 gets back to where it was. You can't even see it. It's so high. You can't see it. 1,200%. 1,200%. Again, let's say it takes double. So it took 3 years to go down. It takes 6 years to go back up. That means at the end of 2029, oh my gosh, years. End of 2029, that is 200% a year. These are just gaudy numbers. Oh my God. Zoom into that. Oh my God. So you telling me if inflation gets back to where it was, and it takes 6 years. Now this is risky though, because again, it's 3 times up and 3 times down. Inflation is going down. I'm making 3 times as much. Inflation goes up. I'm losing 3 times. So risky. However, 6 years from now, with all the risks you took over, you go from 10,000 to $7.2 million. Wow. This, my friends, is Investing 101. Anytime it is a decrease, on the other end of the spectrum, it is a buying opportunity. And TMF right now is a buying opportunity in the long run. Now, this is not a get-rich type of investment. This is something that's going to pay dividends 3, 4, 5, 6 years later. Long term. But believe you me, inflation gets back to where it was in 6 years. Took 3 years to really go down, 6 years to go back up. $10,000 to $7.2 million. Now, y'all better be calling Mr. CFP himself with those success stories. You got to be clients by then. I got a minimum. My minimum ain't 7 million, though. 6 figures, but not 7 million. So you can be clients, and we can help as well. And I'll be able to give better advice than that for you. I said that to say, though, opportunity right now as inflation goes up. You're able to buy something that's tied to long-term treasuries on the more safer side of the investment coin, TLT, the more aggressive side, TMF. But I'm done. I think I dropped jewels for you guys today. Comment below. We in TLT? We're going to get in TMF? Or is Mr. CFP out of his mind? Inflation is going to be high for the next 6 years. Who knows? Like Michael. I don't know. I know one thing. If it does pop, you can make you a lot of money. Be a millionaire like Michael with a $10,000 investment. In some years, though. Not overnight. Anyways, though, love is love. Let's stay prayed up and safe. Let's make some painful profits together, y'all. Peace.
And you just wanna get paid, tired of making the money mistakes. Make a payment on your bills and you still late, yeah. Pay for profits to help you seek change, and you just wanna get paid, yeah. Tired of making the money mistakes. Make a payment on your bills and you still late, pay for profits to help you seek change, yeah. Cut the show and just listen. You wanna feel empowered by making money decisions. Residual by the hours can get you a better living. Bitch at the check, you know, and it could be different, you know.